All right, so we are talking about the ETFs here, and last time we went through the list of what are those 15 ETFs spanning across several sectors: technology, health, real estate, energy, world stocks, NASDAQ, dividend focus, and so on. So as I was explaining, each ETF is nothing but a collection of multiple companies. So instead of investing in one company or 5 company or 10 company, you just invest in, say, this VGT ETF, for example. It has 370 companies. So your money is spread across. There's a lot of diversification. And top 10 companies are having 60% of your money. So you need to know what are those top 10 that can definitely impact your portfolio performance, right? So that's what we are today going to focus on top 10 holdings for the three ETFs that I've chosen. So I'm focusing on technology sector and S&P, and nothing else, right? And if you see the performance of all the ETFs, they're definitely pretty good. But as you go down, say, for example, world stocks, international, that's pretty low because things outside America was very volatile and not as aggressive and as, performance-wise good compared to America. So the technology sector being the highest in the list, right? So that's that. And then we did some quick simulation, Monte Carlo simulation. Say if I had some money and I invested in 3 ETF, just this 3, which is technology, S&P 500, and value, VTV is a value. So value companies are what Berkshire, Warren Buffett is fan of, a value companies, right? They are like Coca-Cola, Walmart, easygoing companies. They don't grow very fast because they've been growing for many years and now they have stabilized. So this is a piece. This is also piece, and this is aggressive. It can go messy, but it's a volatile sector, technology, right? So if I had 500,000, for example, or $1 million, if I invest in this 3 area, what is the Monte Carlo simulation saying? How will it perform in 10 years? So the Monte Carlo simulation is it runs 10,000 simulations and comes up with an estimate. And so a 50 percentile answer would say 13.53. That's the forecast. It's an estimate based on the past performance, right? It's not always accurate. You cannot predict future by past, but at least you know the trend that it was doing pretty good. And the trend is not changing. The technology is still, for example, very, full interest, right? So that's one example. So 3 ETFs over 10 years, 13.53, over 15 years, 13.38 hours. So I think on an average, it's saying that if you have the combination of these 3, you'll get about 13% CAGR, average ROI per year, right? And if you go with more number of ETFs, obviously you're over diversifying, right? Now a 15 ETF will be 11.19, right? This is so many companies. So if you see 15 ETF, that means all these companies. Now there's a huge overlap too. But if I have to see the all companies in America listed, about 4,000. So you are investing in 4,000 plus some international, which is almost 8,000, right? And there's an overlap there too. So maybe 8,000 companies you are investing, and on average, you are getting 11.19 or 11.19, right? So over diversification has its negatives. It's peace. It's definitely peaceful. But you got to make sure that, you are compounding the money faster too. So now at the older age, as you age, as you're closer to the retirement, you have to taper down your risk and you have to go towards broad ETFs or safer ETFs or less aggressive ETFs. And that's usually the strategy. All right. So I'm just doing a recap. Then I said, okay, then I was like zooming in and saying, okay, so personally, my preference is these 3 ETFs. That's what I'm going to do. And then I feel like I'm getting the hot sauce, the aggressiveness in VGT. So VOO VOO, which is S&P 500, is my benchmark. At least I got to have that much money, that much return. Then I'm saying, okay, I'm going to make it a little bit risky because I want more money than VOO. So I thought about adding VGT. And then I'm saying I'm going to play a little bit safe. So I'm looking at the value. But the value and the aggressive will nullify, and I may end up coming to this risk level of VOO. So then it made me think, do I really need a value? Because VGT is 370 companies or 360 plus. VOO is 510. I'm investing in, if not 800 or 900, maybe 400 distinct companies. That itself is a huge diversification. So our tendency usually when we see one ticker, we think it's a one company, but you are investing in 370 companies, right? So for example, VTI, 4,000 companies in US, right? So that's how all this thread in my mind started, right? So today, what I'll do is I'll focus on VGT, VOO, and QQQ. QQQ is nothing but NASDAQ. So NASDAQ focuses on finance, technology, and top 100 companies by allocation in QQQ is the top 100 of that list. So NASDAQ has, I think, about 4,000 companies. So what are those top 100 companies? These top 100 companies, majority of them are also existing in VGT and VOO. So there's an overlap. When I invest money here, I'm investing in Apple, for example, in Apple, Microsoft, and so on. And then if I buy VOO, VOO also has an Apple. VGT has an Apple. So question, what could happen is you may end up over investing in Apple because you are only looking at these three tickers. And are you okay with that or not? You may not be okay. You may not be okay with NVIDIA, right? So what that analysis is, what is that ultimate ETF? What is that ultimate basket you will end up? If you have this three, how will be your top 10 holdings look, right? So that's what I'm trying to do here in this session. So before I do that, Singa, is it okay? Singa Velan, is it okay if I call you Singa, or what do you prefer?
Yes, Singu, yes.
Singa, okay. All right. I don't want to offend you. So he gave me this nice ETF link, and we're just comparing here. And so, for example, here I'm comparing QQQ versus VGT. And if you see the trading volume, and it's pretty good. So this is by Invesco, this is by Vanguard, VGT is by Vanguard. Expense ratios are differing. Definitely QQQ is expensive. The assets, you see, these are almost 200 billion assets. $200 billion are invested in QQQ and 50 billion VGT, right? The daily volume, if you see, 15 billion and you have 174. So VGT is extremely busy volume-wise. And the companies, 366 companies in VGT and 102 in QQQ, right? And then let's see the performance. So VGT and QQQ are quite similar. Definitely VGT is winning percentage-wise, minor. So this column, you see a 5-year average, QQQ was 15.98 and the VGT was 18.67. And even over 10 years, it's beating. 1%, I'm okay. But that's a huge overlap between these two. I mean, 80, can you guys mute? Okay. All right. So that's that. So that's a high level. So see here, see the difference. They look similar, but if you see here, Apple is number 1 in VGT, where Apple is number 2. So this guy, VGT, QQQ is more into Microsoft, relatively speaking. But QQQ also has PepsiCo, Broadcom, right? Tesla is there. VGT doesn't have Tesla. Tesla is not considered technology company. So even Google, I think Google is not there in VGT. I was surprised to see today, not see it. So But this is all definitely, this is a technology ETF, and this is technology plus finance plus other stuff. So PepsiCo, see, consumer is there too. All right, so that's that. This is a good comparison side. There is let me hide the meeting controls. Okay. Then market watch. So I'm gonna search here, and this is our, so let's say VOO for a change. So VOO is S&P 500 index fund. Everything that's in S&P 500 will exist in this ETF. And here, I'm going to look for the holdings. So what is VOO comprised of, right? That's the question. So 30%, almost 30% technology. It's got finance sector, health sector, right? So VOO, S&P 500 is very well diversified. It is very safe. One sector goes down, other may not, and you'll be fine. But then the return reward ratio could also vary. It's a safe place. S&P 500 is a safe place, and 9%, anything above 9% is a good return. All right. And then if you see Apple, so S&P 500 has the highest investment they're doing is in Apple, 7.22, then Microsoft. So if you see, a majority of them are technology. And Berkshire is there, which is value. Alphabet is there, Google. Meta is there, and then some oil companies and health insurance, right? So these are top 10. And so what I did is I copied this, laid over in my Excel. So we are focusing on these three companies. We are focusing on QQQ, VGT, and VOO, right? So that holding is right here. So what I did is I color coded, and I said, whatever companies are common. So these are top 10s of 3 ETFs. So whatever the companies are common, so Apple in all 3. So the yellow ones are they're existing in all 3 boxes. See, Amazon is in VOO, but Amazon is not there in VGT. In Amazon is not, it's not technology company. It falls under e-commerce, and sometimes it's don't consider that. But anyway, Amazon is not in the top 10, at least in VGT. NVIDIA is everywhere. Google is not here in VGT, and that's a surprise to me. Not in top 10. Google is not in top 10 in VGT. Of course, Berkshire won't be there. But so Google is in VOO and QQQ. And Meta is also not there in VGT. So these guys are definitely not comfortable with Meta and Google. It's not there in top 10. All right. So now let's say if I put $100%, all my money. So I have an example here. I'm saying I'm going to invest $50,000. And I'm going to put 100% in VO. And remaining, I'm not sure. So I'm not going to put. So then in that case, my allocation will simply directly follow the VOO here. So the Apple portion will be 7.22% of 50K will be $3,600 and so on, right? And so $13,000 from $50,000 is simply going in top 10 companies. About 27% of your money is going in top 10 companies of total 505 companies. S&P 500, 505 companies. First top 10 is getting 27% of your money, and the remaining 495 companies are getting the remaining 73%. Right? That's what we are understanding from this. And I'm not putting any money in VGT, so there's no money here, nothing in QQ. Right? So I have blanked here because I don't want to overwhelm you. So my bucket right now, my portfolio is this, which in this case right now is just VOO, just S&P, because other two guys, I said, I'm not going to put any money, right? So now I'm going to start playing with the numbers. I'm going to say I'm going to put 50% in VOO. So before I do that, you have to remember certain numbers. So here I have 10 companies. If you guys are not speaking, can you mute? Here there are 10 companies, and what I did here is show me the best 6 companies looking at all 3 ETFs. So this result is my basket's top 6. And 23% or 11,000 from 50,000 is going just in these 6 companies. Now I'm going to start playing around, and I'm going to have 50% in VO and remaining 50% in VGT. So remember here, 11.69 and boom. So now 50% money, 25,000 is going in this bucket. 25,000 is going here. So as I said, Apple gets 7.22% of 25,000 and gets 23.50% from 25,000 for the VGT. And so your overall allocation for Apple is 15%. In other words, 15% of 50,000, which is comes out $7,680 is going in Apple. Or 36% of your 50,000 is going in just these 6 companies. Right? So let's remember now 36%. I'm putting 36% in just 6 companies. Now, if I flip this and say, I'm going to put instead of VGT, I'm going to put in QQQ, then that one, because both are quite similar, it is also pretty high. But your Apple portion went down probably 9.93. So let's see, what was it here? 15%. So VGT is putting so much in Apple that Apple is a good company. So this, in this case, it's nothing bad. But if there was a company like, say, NVIDIA, 4%. If I have this allocation, 4% of money is going in NVIDIA, and I'd say, no, how about we do this one? Let's see, what is the NVIDIA? 3.5, not big difference. But Apple, there's a big difference, right? So someone may say, why don't we do this way? So 36% is should not see a big difference. It's still 36%, right? Someone may say, oh, I'm going to put 75 and maybe 10 and 85, 50. Right? So now it's 29%. Still, Apple is still number 1, right? So that's what, so now this is, as of today, NVIDIA is hot. Things may change, or it may get more hotter, who knows? But from this, one can say that the combination, if I had just S&P and nothing else, I'm playing very safe. The amounts are pretty low in top 6. 23% is the max. And if I just go, say, 50-50 here, I'm all 50%. 50% money. If I do just these 2 guys, Apple is getting 18% and Microsoft is 16. So if someone has to say, okay, if we look at VOO, I'm taking more risk in top 6 companies compared to VOO. Even though I'm spreading across 2, these 2 buckets are very aggressive. But a combination of VGT and QQQ is safer than just VGT, because VGT is putting 23% and 19%, whereas half and half in VGT and QQQ, I'm reducing to 18% and 16%. So I'm spreading more if I have 2 companies. Right? So this will matter not now, but if you have a big amount, $1 million, well, still it's a percentage, but then it would make a big difference. Because you're putting 200K in Apple. and 163K here. And if I do just 100, 0, nothing, that's 72K. 200K versus 72K. NVIDIA is 19,000. Of $1 million, you're putting only 19,000 or 20,000, if I round up, in your, if you just do this. And if you had 50-50, you have 40,000, double NVIDIA. So bigger amount will see that, and the returns on this guy and this guys are high. But if you have smaller amount here, then the return will be, won't be visible that much size-wise, right? So that's my strategy. So I got 10 years to retire. So I like VOO, and maybe I'll do 75-20. That's what I would, for me, sorry, 25. It's almost 30% going in 6 companies, and remaining 70% is all those tiny companies. That's what I would, but that's based on my risk profile. If you are running low, if your numbers are not that great, you'll have to add some aggressiveness, and you have to be ready. It can go drastic up and down, and I'll show you example. Why is this coming up? Right, floating. Okay, let me show you an example. So let's say the volatility difference between VOO and we can do VGT or QQ. They are quite similar in the volatility. All right, so see here. So this is, so let's say 10 years. Orange line is the VGT technology. And if you see the volatility, the depth, how down it went, this probably went 40%, and this went 30% during Corona. So you had a higher anxiety here, and relatively speaking, less anxiety here. But the returns were pretty high, much higher. Over 10 years to 21%, this is 530. But this will be zoom, zoom, up and down, up and down. And I think there are charts here too. The sharp. That's the drawdown. Drawdown is how much low can it go? Let's say 5%, 5 or 1 year. So how much, if bad things happen, how bad can it be? So VGT, orange line, was as down as 36, 35% here last October, and whereas S&P was 22%. That means if you see your portfolio, you're very sad at this point because you lost more than S&P did. So you'll start loving S&P. But at this point, now this is just 1 year, but if I say, well, this is a volatility. So here right now, the volatility is drawdowns are very less. So, but at this point in time in October, your portfolio was much lower if you had put a lot of money in VGT compared to VOO, and you would be cursing me and everyone else who recommended VGT. But the same VGT beat, and this is 1 year, comparing 1 year to 1 year. So October, it was here, and same VGT is beating now. And if I look at over 10 years, it's beating with a very high margin. In other words, things that are, risky, act like this. And your decisions need to be looking at how big is this delta? What is that? I take a risk, so what are the rewards? How big could be the rewards? And do I have the tolerance capabilities? If you don't have it, you'll be very sad here, very sad here. Very sad here, extremely sad. Your portfolio lost a lot in 2022 if you were on the technology side. Same portfolio is coming back up now. Right? This is, sorry, that's a Sharpie. What was it like? Right here. Came back like anything. So here you go. That's another volatility. This orange is more volatile than the blue. Blue is more softer or less zigzaggy, right? So that you have to decide that. And the zigzag, the things that contribute to that zigzag is those top 2-3 guys. These guys are right now bumping up the market. They are the ones that are giving you amazing returns. Only 5, 7, 8 companies are contributing to the bull market right now. All right. So it's a short analysis from my end. We can discuss anything else. Questions? See, when we do allocation, we think only from this percentage. And if you are not fan of NVIDIA, then you have to look at this percentage. This allocation is a derived holdings of 75-25 from this 3 buckets.
This is Jay. I have this question. I have a Roth IRA opened in Fidelity, and I want to do some investing. And if I'm in like my 45 years of age, what's the distribution you recommend? Like I would like to go aggressive. Yeah.
You want to go aggressive? Yeah.
Yeah.
And you said you are 45?
Yes.
So first of all, don't reveal your finances here. I'm recording this call. So, but
Yes,
you have to keep in your mind how long you have been investing.
I have been investing for 5 years.
In America?
Yeah, in America, yeah.
Okay. So you still have 20 years to go. Is it a double income, single income?
A single income.
Okay. Are you maxing out your 401k?
I am trying to.
Okay. So these questions are...
changed my employer. Yeah, I changed my employer. So I didn't go with my employer, the fund. So instead I put I stayed in my original Fidelity itself, and I opened another Roth IRA. So that it will stay there, and I trying to invest. Yeah.
Okay. So I'll give a generic answer. First of all, I'm not a, certified financial guy, but
yeah, I know.
I have an experience. I've learned the hard way also. So my guidance will be very generic. Max out your 401ks right now. And we still have 20% market recovery remaining with NASDAQ. Technology is driving it. S&P has 12% remaining. You are guaranteed to receive that money because the market will come to the all-time high. It may not go further up, or it may take its own time. It will happen because the money is losing value. So stock market definitely, with the inflation, the prices of assets and everything is going to go up. Your house price will go up, raw materials will go up, company prices will go up. So stock market will always go up. The value of assets will go up. So question is how long it will take. Will it happen before your retirement, and what pace? What is the speed of that happening? We don't know. Last 10, 12 years were the best. Now, if the last 10, 12%, if you had invested in the right buckets, you'd have made a lot of money. And so if I go back and see here, last 10 years, 19% gains were received in VGT. as compared to say,
Mhm.
VOO. If you were an S&P 500 guy, wanted to play safe, 7% difference is a huge difference. So generically speaking, and you can connect with me offline and share your actual numbers if you wish to. I've done this analysis. And all I can say, what I've seen, my consistent advice is max out your 401k. And you're 45, so you have 20 years to go. You have to have most of the stuff in S&P or above. Above will be, VGT or QQQ. You have to add some hot sauce, some risk.
Okay.
Then you have to decide at what age you're going to slow down, 50, 55. Then you reduce the VGT portion, technology portion. But this is not an advice for everyone. I am a super aggressive guy. I'm 53. I'm very aggressive in VGT and all that. Every person is different. So this is not advice for everyone,
Yeah,
because what happens is, if you are in an aggressive investment and if the stock goes down, you will have tendencies to sell and incur loss. So that impulse will happen. If you monitor your portfolio every day, every week, that means you are really concerned. And if you don't have that risk tolerance, then you should not be playing that game. Then VOO is the best. By default, we all want to make at least what America's top 500 companies are making. Top 500 companies in VOO. If the company doesn't do good, they'll kick it out and they'll replace it with another one. Like they kicked out Dish Network, Dish Company last week. They put Palo Alto Network in 500, right? So this is always the best list. And you will get a 9 to 10%. The last 10 years were awesome. So you connect with me offline. I will set up a separate time, 1 hour. And it also depends on your goals, right? What do you want to do when you retire? How big house, how many cars, how many kids, education, have you saved for them? Those questions also matter, right?
Yeah, sure. Yeah, thank you. Yeah, I
Because
will
if you
do.
put so much money in the kids' education, then it's gonna slow down your retirement savings. Or it could be vice versa too. So,
Yeah.
but the goal is what people have made mistakes. I'll tell you, and I also made a mistake. When I was young, I didn't have access to all this knowledge, and the systems were not electronic at those days. You have to read the pamphlets and all that. And once you start, so snowball, I had written about a snowball. If you search in the group, there's a snowball effect. So if you look when, say, let's say you came to US at the age of 30 or 25, that initial snowball where you are young, you can afford to take risk more. So if I was 30 years or 25, I would probably put 50% here and maybe 25 as an example. Now this is an aggressive allocation. So in that case, what will happen is the portfolio will be volatile, up and down, up and down. But it will become very big. That snowball, initially the snowball has to be really big, because the bigger snowball will also get bigger. If you start safely, initially, if your risk tolerance is very low, you cannot take risks, then your snowball will be small. And then when you turn 45, you realize, oh my God, my balance is not enough. Now I'm going to play aggressiveness. That's a wrong strategy. So what happens is when you have more money, you're taking more risk. I would rather take a risk at a snowball level at a younger age, take more risk and then slowly taper down your risk. And that's the right strategy. You can afford to have this allocation at, say, 30 years, you have 100K. And so whatever volatility happens, it will impact 100K. But if you have, $2 million, then even a 10% drop will be 200K. A 30% drop is on a $200 million is 600K. So you want to play safe when you have a bigger amount. You want to play less risk when you have a bigger amount. Bigger amount is when you are older. So all the guys who are less than 40 years, if they really want their portfolio to grow faster and reach a big number in their older age, they have to do some risk. But if they cannot tolerate a risk, honestly, they should not be in this game. And if they don't have a skill to do it, then this is become a Las Vegas. So you have to change the asset allocation every 5 years. You have to change. So this is say at the age of 30, 100K. Then when I turn 40, now I have, let's say, to 300K. Then I may have to taper down to 40. Now I'm going to VOO side. This allocation needs to be readjusted, right? And that the ideal formula is there's an age thing. As you get older, 90-10 or 80-20, they have breakdown in stocks versus bonds and all that. Right. So you have to do that. I can have a separate session and discuss each one of you. But simple formula is when you retire, whatever the amount you think you will have, and so let's go to those calculators. And which one was this one? This resulting ETF target. Stock amount. There you go. This is a very good one. So let's say average you are getting 9% a year. If you're a 45-year-old person and you pick what is your current net worth from this list, let's say 535K is your current total cash net worth after all debt and everything is removed. This is what you have, tangible assets or cash, which is invested. It's okay. And if it grows 9% a year, then at the 535K will be 800K, 1.2 million, 1.9, 2.3, and at 65, you'll have $3 million. So you can guess where you fall here, whatever is your age, pick that bracket. If you're 40 years old and if you say, Nimiji, I only 250, 225K, then you are here. Then at 9% average, you'll make $2 million. In fact, I did reverse. Right, at 65, if you have $4 million, then what do you have at this? What do you need to have at this age? At 45, you need 890K, assuming you gain 9% interest gains every year. Now, where the assumption here is I'm not putting a single 401K dollars here from 45 till 65. But this will give you a rough estimate. If you're 535K at 45 years age, then you have $3 million. Now, if you're going to max out 401K for next 20 years, it's going to cross 5 million. So this is assuming you're not putting any new investments. This is what is your current situation. This will tell you that. That's another one. Mortgage net worth forecast. Yeah, this is quite similar. So when do you want to retire? What is your current? How much you're gonna withdraw? 4%. How much tax rate? So my current net worth is 500 million for 500,000. I want to retire at 62. And these are the age. So if I am 40 years old at say 9%, it will grow to at 40 years old. So I have 22 years to go. In next 22 years, it will become 3.2 million. And after tax and everything, you get $8,323, today's dollars. Right. So if you have, can you live on $8,323 today? Very likely you will have your house paid off and all that. So I don't see any issues. Bigger expenses should be gone unless you keep on buying a bigger house. Right. Then there is another one. This is another one.
Nimish, can you share this particular document with me? This is Vidya.
Yeah. It's
Thank
all
you.
there in our Zoom
Okay.
drive. Yeah, I'll send you the link.
Okay.
Yeah.
Okay. Thank you, Nimish.
Yeah. This is another one. And this may sound negative to you guys. This will probably hurt you. I don't want you to, but this is a reality. Okay. So for example, today's current year is this, and let's say you're 35 years old. You're putting $2,500 each month. Each one. It could be a combination of 401k, Roth IRA, or whatever, brokerage, and 9%. Your first million will take 16 years. If you keep on doing this for 16 years, $2,500 each month for 16.1 years, you'll get $1 million. So that your age is 51.1 years. But if you, so it took 16 years to grow first million, right? It took 16 years to grow first. Second million grew in 6.5 million. So at 51 age, you had $1 million. At 57, you had $2 million. So if you see this column, it's reducing. That's the power of compounding. So first million is always super tough. But once you enter the first million, next one will come in 6.5. And then the following 4.1. In other words, 5 million, you will be done in this many years. Remaining 16 years. First 16 years took 1 million. Remaining 16 years will give you $5 million. That much powerful the compounding is. Right. And so if you see here, year by year, year one, 35, each year, each month you're putting 2,500, so $30,000 in the year one. Then the compounding happens on this 9%. Next year is 62. And if we continue at 16th year is 16.1 is $1 million. Right. And then at 32, you'll have almost $5 million. So everyone gets scared, man, I don't have enough money. Well, you have to wait for this many years. And 9% is aggressive. Let's say I'm going to go aggressive. I'm going to go more VGT. Well, it's not a huge reduction. Still, you need many years, 14 years. That means for 14 years, you are gaining 12% each year. And you're putting $2,500 each month. This is a commitment for so many years. But this math, you may not remember. So the simple way to remember is max out your 401k. And based on your risk tolerance, you want to bump up this number. You want to get good average, yearly average, because this journey is pretty long. So imagine, say, your kids graduating from, this is good for them. And if they put the $2,000, 9%. Right. So the kid is 25 years old or 22, coming from college. He graduated. And you were able to convince your kid, you're going to put $2,000 every month in investment. At the age of 40, he has first $1 million. And when we'll have fifth million, 5 million, at the age of 56. So at the age of 65, so I have 64.4. He will have $10 million. It's possible. So you have to start early. You have to put amount. Right. So at 64, he has 10 million, 64.4. Now he was pretty good investor, meaning he knows where to invest. He will have 10 million at 56. See, I bumped up 12%. 6 years gone. So he probably will have 15 million when he retires at 65. Because he was smart here. So you have to be smart here, start early, consistent here, and be good. So this is where that ETF research or where you invest. This is very important. This number is very important. And see that 16.1 did not drastically change here, but this number did. So compounding is that this is a small snowball, big, 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 and then the years reduce here. It's doubling. So 2 became 4 in 5 years, roughly. 43 age, he had 2 million, and he had at 48 in 5 years, he doubled it. All right, that's that. This is a target goal. This is a strategy. This is a good one. So the person who said, Jay, I think he said, so that, I want to retire at 65 and I want to have say $3 million. I'm 45 right now. And my current total investments is, let's say 200. Let's make it interactive. So I have 200K in my bank account, my investments. I'm 45 years old. And I'm assuming I'm going to get 9%. What do I need to do for $3 million goal? This is my goal, target goal. At 65, I want to retire with $3 million. Right now I'm 45, I have 200K. And I think I'm smart enough to get at least 9% each year. Then this is an action plan. Well, if you want this, put 2692 each month for 20 years, 65 minus 45, and you will have $3 million. This extra 401k, this 2690 we are doing will contribute $1.7 million, almost $1.8 million. The 200k you already had over 20 years will become 1.2. So your total will be $3 million. Right now you may say, I have more than that. I have say $4 million, 400k right now at 45. Then you'll only put $893, $900. And get $3 million. It will accumulate at 65. Someone may say, well, I want to retire early. Then you have to put more, 3,800, and say I have 600K. And I'm pretty good investor. And saying, you're done, buddy. You don't even need to put, in fact, you can, it's minus 222. So let's put 10%. Or say you want $5 million. And you are average investor. And you want to retire at 65. $2,000, one max 401k. If you can't remember, one max 401k that gives you at least 9%. No bonds, no international stock if you are young. If you're older, yes, play safe. Right, so this is good. All these calculators I've created, and these are, I'm not copied or anything, okay? So just so you know, there's no copyright here, but I'm willing to give you guys for free. It's there in our group description. There's a zip file for each. So this is target goal is good. Stock performance. So see how stock market works. Up and down will happen. So if my dad had put, say, $100,000 at 1975, for example, my dad put 100,000 in 3 buckets. How would have they performed? So in year 2000, it was $1.7 million before year Y2K started. So let's look at S&P 500. But the middle column, this is S&P 500. So my dad had put $100,000 in 1975 in VOO and just left it, meaning he did not add any new money. From 1975 to 2000, It's 25 years. So at 24th year, 1999, he had $1.9 million. Then 2000 crash came. So 1.9 million came to 1.1 million. See that? So this is where heart attacks happen. You're so sad, you're so negative, you hate a VOO. You start hating VOO. Why did I not invest in bonds? This, that. Right. Then you are slowly recovering. 1.5, 1.6, 1. Now you are happy here. Oh my God, I'm back to 1999 value. 2006, you recovered, almost recovered. 2008, 7, you're fine. And then crash happens again. Great recession, 2008 crash. You're back to 1.2 million. 1.2 million is less than 1997 of 1.3 million. You're completely devastated. You would be thinking, you know what? I wish I had sold everything at 1.9 million. I could have paid off my house, this, that. Looking back, anyone can say, no one can predict this, right? So now you're at 1.2. So this example is my dad just kept it. He didn't worry about market. Became 1.5 and then so on. And then look here, 3 million. Then the Corona came. Well, Corona was positive, right? Because it all recurred in the same year. But 2018 was down. 2022, the recession, the inflation crash came. And now we have 5.4 million. 5.4 million. That is simply patience. So the smartness is where you invest, how much patience you have, and the recurrence of investment. In this case, recurrence is not there. It's a one-time investment. Same money. So this is VOO. Now we look at QQQ or VGT. So the Nasdaq is QQQ. Well, top 100. So if my dad had put 100,000 there, what would be the total? 8 million. 8 million versus 5.4 million. But this guy went up and down like anything. He had $3 million in 1999, and it came down to 1.2 million in 2008. 1/3. See the volatility? And then 4 became 5, and within few years, 7. 7 became 10 within 1 year. 7 became 10. This is a snowball. The snowball was so big that 40% gain on 7 million bumped it up to 10, and 10 became 12 because he got 21% next year. And then it became 8 also. So bigger the snowball, of course, a small percentage will be a big amount. Right. So that's that. What else?
Hey, Nimish, right? This is Tejas. So
Yes.
question. I think you are talking about, in this scenario, just talking about, I guess, investing in ETFs, right?
Yeah.
Now, and I think the first advice you gave was max out your 401k, right? Now, if you are, let's say, also interested in like maybe investing in real estate, right? Then how do you, I guess,
So I'm not
recommend the portfolio?
valid question. So valid question. So I never jumped into real estate because for me, the returns were not high.
Mm-hmm.
But my math has been flawed also because each area is different. Also depends on the location. So I was in Detroit, Metro Detroit, in a decent city, very popular city. And I lost money like anything. Then we moved to Austin 12 years back, and I doubled my money in 10 years. And then in 2020, the Corona thing, it went up like anything. So it's hard to predict. Plus, the average I've heard, okay, from everyone is 5 to 7%.
Mm-hmm.
And S&P is 9%. So I tell people, especially younger people, see, some people, what they do is they want to diversify just for the peace. But
Right.
diversification is going to reduce your returns also. You are, and I'm not saying real estate is bad. I'm just saying, giving an example. So that what was that example I gave here? This one, I think. This is too much diversification, too many. So the 3 ETF is going to give you 13.53 and this is going to give you 11.9. So now here also I have real estate. Look at this, the real
Mhm.
estate sector. 5.78% in REIT, right? The 5.78. If so, are you gonna diversify because you're scared of technology? So I'm gonna put some in utilities, some here, some here. Well, that's gonna reduce your overall gains. And if you may be okay, then it's okay. So real estate, another thing, for my opinion, is you need decades of waiting. So, a property management could be headache too.
Mhm.
So
I I look at it from the perspective that yes, I do have to pay down payment on the property, but then someone else is paying off my property, and I don't have to.
yeah,
But you're right. I mean, about property management and some other headaches that it comes with.
see, grass is always green on the other side. So for me right now, I am mentally, questioning myself that because I don't know the other side with the experience. This is my maths thing, my observation thing, but I've not gone through it. So I'm thinking next 5 years, I'll probably buy 2, 3 properties and for my son. So I'm creating all this thing for him because he's young. So as I said, the baking time is pretty long. So by the time he turns mid-50, mid-40, he'll have it ready. The property would have doubled and would have been paid off. 30-year cycle is done, mortgage cycle. So,
Mhm.
but for me, I think I'm late right now. Plus, if I get more than 12%, I should be happy what I'm doing. So in real estate, we don't know what's going to happen because the commercial side is right now really messy.
Mhm.
So, right? Don't know, right?
Okay.
Don't know. What we got in 2020 is probably not going to happen again unless we get another pandemic.
Okay. Uh,
Less than 3% mortgage will not come back. So and they're paying the price right now. So they learned the
Yeah.
lesson too. So, but if you want to
One.
put, because see, you have to satisfy that other side, then which I am unsatisfied because I have not done it. I'll put 20%.
Mhm.
Remaining 80%, you play aggressive game here.
Okay. One other follow-up question. So I'm 45, and I started late in the game, and I went over aggressive. So I started probably investing in the last, I would say 5, 6 years.